Did you know that the engulfing candlestick strategy is one of the most powerful trading techniques, yet many traders struggle to use it effectively? If you're not careful, you could end up making costly mistakes. In this video, I'll show you a highly effective trading strategy with an 87% win rate. By the end, you'll know exactly when to enter and exit trades using engulfing candlesticks. Make sure you watch till the end. Don't skip this video or you'll lose money. The engulfing candlestick pattern is a key reversal signal that helps traders identify potential trend shifts in the market. It consists of two candles. When a green, bullish candle engulfs a red, bearish one, it signals that the price may move upward. Conversely, when a red, bearish candle engulfs a green, bullish one, it suggests that the price might drop. This pattern is a great tool for spotting market momentum shifts, but it shouldn't be used alone. To increase accuracy, we must confirm signals with other technical indicators and market conditions. That's why we'll combine this strategy with supply and demand zones, which help pinpoint high-probability trade setups. To use this strategy effectively, we need to set up two key indicators on TradingView. The first is the Fluid Trades indicator, which highlights supply and demand zones, and the second is the Engulfing Candlestick indicator, which automatically identifies engulfing candle formations. The Fluid Trades indicator makes it easier to spot supply and demand zones, allowing us to anticipate where price action might reverse. To add this indicator, search for Fluid Trades indicator by a verified TradingView author. Before using it, we need to fine-tune the settings for better accuracy. The swing high-low length should be set to 50, the supply-demand box width to 5, and the history to keep to 5. These settings help ensure that only the most relevant price zones are displayed. Once applied, the supply and demand zones will be marked on the chart. When price reaches a supply zone, it tends to reverse downward, creating sell opportunities. When it touches a demand zone, there's a higher probability of a buy trade. Next, we need to add the Engulfing Candlestick indicator by Remunaz. This indicator highlights valid engulfing candlestick patterns, making it much easier to spot potential trade setups. Unlike the previous indicator, this one doesn't require any settings adjustments. It works perfectly as is. To enter a buy trade, we first need to wait for price action to touch the demand zone, which is marked in blue on the chart. Once the candlestick's wick touches this zone, we then look for confirmation from the engulfing candlestick indicator. If the next signal appears as a green engulfing candle, it confirms our buy entry. However, if the next signal is red, we ignore the setup and move on. When entering the trade, we must also set a stop loss slightly below the demand zone, as prices may retest the area before moving upward. For take profit, we use a 2-to-1 risk-to-reward ratio, meaning the profit target should be twice the amount we risked. For example, if a retest occurs at the demand zone and a green signal confirms our entry, we enter the trade at the close of the candlestick. As the price moves in our favor, it reaches our take profit, resulting in a successful trade. Sell trades follow the same logic, but in the opposite direction. First, we wait for price action to reach the supply zone, which is marked in red. If the next candlestick forms a bearish engulfing pattern, red candle, this confirms a sell entry. Once the conditions are met, we open a sell trade at the close of the engulfing candlestick. The stop loss is placed slightly above the supply zone to account for potential retests. For take profit, we again use a 2-to-1 risk-to-reward ratio to maximize gains. To make the most of this strategy, always trade at key supply and demand levels where price action is likely to reverse. Following the set rules is essential. If all conditions aren't met, avoid taking the trade. Risk management is also crucial. Always stick to a 2-to-1 risk-to-reward ratio, as this helps maintain profitability over the long term. While this strategy works well on the 30-minute time frame, you can test it on different time frames to see which one fits your trading style best. This strategy is simple, powerful, and highly effective when followed correctly. Try it out and let me know your results in the comments.